G'day everybody, welcome to another weekly general update for the 10th and 11th of March. And it seems like these days every week pretty much has lots of very significant events and some sharp moves in the market, and the week that's just been was certainly no exception. So let's get on and have a look at what the action was. Just a reminder on the general advice nature of this video. Now the action for the week, the S&P did have a sharp downward move on Tuesday, Wednesday, and then regained that lost ground in the last 3 days of the week. So ended up pretty flat, gained just 1 point, and really the last 3 days higher was pretty significant. And I'll just explain the pattern as it is unfolding when I jump over to the charts. The strength in the market to me suggests that this correction now could be complete, because I was looking for 3 waves to the downside, which would be extremely normal, and we really have only had 1 dip, but the strength of that rebound suggests to me that it's possible we could just go straight back up from here and form a new high. A close above 1380 will be the confirmation of that, but I would still give it as 50-50 that we still could see some mildly lower prices yet. Now the other big thing that was a real surprise on Friday night is that the US dollar went up and everything else went up, including stocks and commodities. Now normally the US dollar moves inversely to stocks and commodities because money flows out of, when money is flowing into the US dollar, it's coming from somewhere and it's coming out of stocks and commodities and going into the so-called safe haven of the US dollar. And I can't recall sharp moves in all of those all to the upside. So it wasn't like these were tiny moves. They were all significant moves. They all finished basically on their high of the session, and we had the US dollar going up with everything else. And I've not seen that before, and I don't really have an explanation as to why it would be the case. It'll be very interesting to see what it does over the next couple of days. Now, the ASX 200, again, disappointing, lost 60 points on the week, and again, we're underperforming, and a good part of that was the materials sector. It broke a key support line, as we'll see, and materials was the weakest sector, basically on fears about China. I think those fears about China are way overdone, but nevertheless, that's how markets seem to react these days. Now gold finished flat for the week, but again, a real roller coaster ride. It got down to within $8 of my target support level at 16.58. Got down to 16.66, and I guess you could interpret that it did complete 3 waves to the downside. So it's likely now, not completely confirmed, we need to close above 17.25 to confirm it, but it's likely that the wave 2 correction is now complete, and that will push higher in a more significant leg towards 1900 and beyond. Now the GDX and the GDXJ, which is the gold mining indexes in the States, were both lower on the week, so again gold stocks really significantly lagging the underlying commodity. Silver was just down by 40 cents for the week, pretty mild, and is really the same pattern as for gold. It appears to have completed a wave 2 correction as well, and if that's the case, and I'd like to see a close above 35.50 to confirm that, then we're looking for $40 plus over coming months. Now oil also dipped a little bit, but has turned back up again, and oil is looking extremely strong. And surprisingly, it's having little impact on global economics. Normally, oil at these levels would be causing some real jitters about global economic growth, but we're not really seeing that at this stage, so that's a little interesting and surprising. Copper lost a little bit of ground on Friday night, but is still not that far off $4 a pound. It's about $3.85 at the moment, so really copper's still telling us that that things are still, pretty buoyant. And I also look at a stock like Caterpillar, which is the world's biggest earth-moving and mining equipment manufacturer, and the chart of Caterpillar really is very buoyant still. We had a little mild pullback from the double top, which is exactly what you would expect. But the ongoing strength in the share price of Caterpillar tells a different story to what the media is saying about China. So I always like to look at charts at the end of the day because the media comment may or may not be correct. Most of the time it's not correct at the extremes, and I would always much prefer to look at actual chart action to see where the money is actually going rather than where people think it should be going. Now just a couple of general comments. With America, they've obviously still got their problems in housing and debt. But job creation, and especially in manufacturing, is showing a positive trend. They've just had 3 months of over 200,000 jobs created, and that's really is a positive now. One month is an anomaly, 2 months could be similar, but when you start to get 3 months of that sort of dimension of job creation, it's really underpinning the fact that maybe things in America are turning, and certainly from a corporate perspective, a lot of their corporate profit results and the amount of cash they've got on their balance sheets is really very strong. So it could be a case of the American ingenuity is basically coming to the fore again. Now when you look at China, the growth forecast was reduced from 8% to 7.5%, and everyone's had a mild heart attack over that. But when you look at it, 7.5%, 99% of the developed world would kill for a growth rate of that nature. So it's still pretty strong. And this is a change of leadership year in China. So you can expect they're going to do whatever they need to do to make sure that there are no real hiccups in the Chinese economy. So I'm not too concerned about China at all. Yes, there'll be ups and downs in commodity prices, but the underlying supply and demand, I believe, will continue to be robust. Now, thank goodness the Greek debt deal looks to be done and completed, and that'll probably get Greece off the front page for at least a few months, which will give us a little bit of respite. That was getting all a bit boring. And Iran and the situation with oil, to me, is the real wildcard. That's a bit of an unpredictable situation there, and could turn markets quite significantly. But I guess we can't sit around and wait for what happens there. I think you've just got to progress on what we know, which is things aren't looking too bad. Certainly the market momentum is quite strong, and I think we move forward with just a little bit of caution, bearing in mind that there still are some issues out there. So just looking at it from a strategy point of view, to me the S&P 500 could go either way in the short term. If that direction is down, then it's likely to be mild and fairly begrudgingly choppy, I would suspect, and might play out over another week or so. But a close above 1380 is significant and would suggest that we're now heading towards 1440 area. So they're the areas to look for. But I think any downside will be mild, and it'll just be kind of choppy, sloppy action, I would expect. Now every trader needs to make a decision about what level of overall exposure they should have for the current market conditions, and that level that you choose is obviously highly dependent on your trading style and your tolerance to risk. But my message is you need to decide what level of exposure you are comfortable with at the moment given where the markets are sitting. My recommendation is that you have some cash up your sleeve, because I think there will be some volatility, and I think there'll be opportunities to buy some outstanding stocks at a cheaper price than where they are now. Now just looking at entry techniques, I think under the current circumstances where markets could go either way, I'm looking for as much of an edge as possible, so I'm using reversion to the mean approach, but using it very selectively. So I'm really just trying to pick off the best opportunities that I can find. I would be very careful about buying into just anything and everything because it's going up, because those prices can come back very quickly on the small caps. Now when it comes to the exit technique, I'd be taking partial profits pretty regularly, and I'd be exiting fully on confirmed reversals. So let's just have a quick look at the charts. This is the S&P. I was expecting a move down to at least 1326 or possibly 1294. Now we got to a low of 1340 and I was expecting a small bounce up. So the first 2 days of that was fine, but 3 days in a row and almost back to a double top has me now in two minds about whether we are going to see 3 waves to the downside. So we've had 1, we've had 2, whether we're going to get a third leg down to 1326, we'll have to wait and see. But a close above 1380 would indicate a push higher, and I'd be looking at 1440 as the next area, and then possibly 1550 after that. Let's just have a look at the US dollar index, show you what I mean. We had three strong days up out of 5. And it looked like the US dollar had reversed. We then got a couple of days down, and then of course Friday night, which is really very strange. That's a strong move in the US dollar, and it was in the dollar because the euro went down, the Australian dollar went down, so it wasn't just some quirk in the US dollar index. It was a genuine currency move, and it's really going against what you would expect. Let's just have a look at oil. So this is oil, Brent crude. We're now back up at a double top at $126 a barrel on Brent crude. And the American index, which is light sweet NYMEX crude, not quite at a double top, but sitting around $108 to $110 a barrel mark. So still very strong on oil. Let's have a look at gold and silver. So this is gold on a daily chart. So you can see we had 1 leg down, second leg to the upside, third leg down. 1658 was my target, so you can't quite make it out there amongst all the candles, but 1658 was the level. We got to a low of 1666, which is pretty close. And I think if we close above the high of the 2nd of March, which was 1724, then I believe that will signal that there'll be a higher high, and I believe we'll then be heading back up towards 1820 and then 1900. And we'll look at silver. So same pattern, 1, 2, 3 to the downside. Didn't quite get to the level I was looking for. I was looking for 3180. We got to a low of 32.46 and then started to bounce up from there. And let's have a look at the Australian market. So you can see we had a big wedge pattern here on the Australian index, and it was getting tighter and tighter, and I spoke about this over the last couple of weekly updates, and eventually it was going to break one way or the other. Well, it's broken to the downside. However, that could prove to be a bit of a false break. And if the US market does go up, it's possible we could head back into an uptrend from here, but it really just does depend on the US market. And the materials sector, this is it on a weekly chart, was really the strongest, the weakest sector that we had in our market during that period. So that's the update for this week. It'll be a really interesting week, and the first couple of days will be really quite instructive for us. So I'll see you again next weekend. Cheers.
If you want to trade and invest with us with a big edge on the market, go to our website, specialistshareeducation.com.au. You can access our free video series on creating trading cash flow and smart investing. Plus, you may also register for our weekly Ask the Expert webinar.